The title of this panel is From Parallel to Integrated, What Institutions Need to Fully Embrace Digital Assets. And we were having some back and forth about this because obviously institutions can be defined in many ways. So you have the institutions from the government regulatory perspective, you have the institutions from the TradFi, the financial institutions, the banks, and then you have the institutions from the sovereign wealth funds, pension funds, other large institutional investors' perspective. So while we'll be focusing more on 3 and a bit of 2, we do also want to give some context to 1, bearing in mind we've already discussed regulation at quite some point throughout the conference thus far. So what I'd like to start with is taking a look back at the last 12 months to see really what's changed. So last year at CFC St. Moritz, one of the biggest roadblocks discussed was regulation. So I don't want to labour the point too much, but just taking that into account, so the changes in regulation, what have been some of the key moves since we were here last year on stage that have made it easier for institutions to enter this space? And I'll start with you, Paul. Maybe you could also give because I know you have some regulatory thoughts as well, and maybe just give the global perspective and then we can narrow down.
Yeah, I mean, I think it primarily comes down to trust and integrity and, who's actually checking what your counterpart is actually doing. And that's one of the reasons that, a regulatory framework or a regulatory environment is one of the most important things for any of these institutional investors when they're seeing who they trust to either conduit their assets through or to manage those assets. So, I think the biggest change certainly over the last year has been increasing noises, increasing clarity coming in the US. So whereas until probably a year ago, US was not top of list of our priorities, it's now very much become our list, top of our list of what we're looking at. And so finding a way to access that and access that market has become really, really important. So, we are regulated in multiple jurisdictions. We offer our clients across the world, different entities depending on where they're located. And we find that absolutely critical. So, yes, we are a heavily regulated organization, but, our prime and sole focus is really the institutional market, as broadly defined as you did.
And has that knock-on effect been immediate in terms of, yes, this regulation, you're like, okay, that's great, that's going to be a pivot for us to move more into that market? Or is it something that you've seen sort of building up in anticipation?
It's definitely been building up, and we've got clients also. For example, Europe. We're regulated in Jersey, which has been completely satisfactory for a long time. But now we're finding that clients actually need a MiCA license as well. So some of our clients are insisting on that. So again, we've had to extend licensing into Europe, where previously we hadn't to do that. But that's actually a good sign because it means that more organisations within Europe are actually considering accessing the market and asking participants like us to go and get licensed.
Exactly. And I know we have a number of different viewpoints on this panel, so I want to extract all of those. What have you seen, and maybe we'll go next to you, Fernando, about the key moves in the last 12 months that have enabled more institutional access?
Absolutely. I think what the changes in the US have been critical. I myself am based in Tokyo, in Japan. For many years, Japan and Singapore were, I would argue, some of the most forward-leaning jurisdictions, but they were still waiting for the big banks, the big asset managers in the US to make a big move. So even though, again, you could try to test some things in Japan, Singapore, Hong Kong, you name it, at the end of the day, most players putting that on a sandbox, right? Or they were doing pilots, right? But they were not quite ready to do crypto or detail from a profit center. But now that we have the biggest capital markets in the world, which is the US, right, start to be more receptive to this tech. And now we have access to a market that can give you the economies of a scale that you need to justify a different approach, right? So it was quite eye-opening to see many banks and asset managers, not only US, also outside of the US, start to move their initiatives from a cost center, from the innovation or R&D departments to a business unit. I think that is the big change, right? So now that those who are driving crypto have clear KPIs. Whatever these are based in revenue, not how many POCs or projects we've done the last fiscal year, right? So I think what makes me quite optimistic, right? That this time around, the mainstreaming of digital and blockchain is going to happen.
And that's a good segue to you, Karl, given you have the asset manager perspective as well. What have been some of the key changes to enable more in the last 12 months?
So I think the regulatory certainty is there, or at least has been there for the past year, and I'm talking about 2025. This was the reason why things were not moving before that. Now, what's been happening, and we've been in the UAE for the past 2 years, regulated since last year, so really close to the allocators in the region. What we've seen happen in 2025 is getting into crypto, but the TradFi way, right? So what's happened is most of the big allocators, and if we're going to talk about sovereigns, and we're going to leave banks and financial institutions aside, so allocators that allocate their own capital today got into crypto by the TradFi way by using the ETF, right? So that was their first step into the game, and the reason for that is very simple: is easier to implement, right? They deal with instruments they understand. There's no additional operational work that's required. There's no additional knowledge within the teams that's required. So that was the first step, and I'm going to make a parallel with the VC world, startups and that are trying to partner with big institutions. In this case, it's crypto trying to partner with those big institutions. Things take a lot of time, right? I think there's only one bank in the UAE today that offers crypto trade, or one, I would say, legacy bank that offers crypto trading and custody, which is RAK Bank in the UAE. The others haven't moved. They are moving, but at a very, very slow pace. So that's the first step of that adoption. We do crypto, but we do it in a way we can operate easily. And we'll talk about what are the next steps that need to be done later.
Yeah, on the very positive side, what we've seen this year, I agree with what the fellow panelists are saying, is that many more of the traditional firms are asking questions and are actively looking to be educated. Of course, they come sometimes from quite far, right? They've got to really do this setup if they want to go beyond the ETF, but they are starting. They're looking for secure, trusted counterparties to work with, and we've been Asia's safest for a long time now, so we get a lot of that demand. Also from and speaking of demand, we see a lot more being driven from a demand point of view rather than from a supply point of view. So many of the providers, like for example here Franklin Templeton, but many others as well, they look from a demand point of view, what can we offer, and are really looking at, okay, how do we also capitalize on this tokenized world, and can we get into this world. Another example is we launched structured notes in 2024, and we're distributing those to other private banks, and we really see the demand for that, for example, pick up, and that's a testament to how banks have evolved from not being willing to offer this to their clients at all to now being really willing to step into that.
When you say the supply is not there, can you go into a bit more detail on that in terms of what's missing?
Oh, just the bare fundamentals to start with. They've got to set up custody. They've got to set up their compliance infrastructure. They've got to understand the market. They've got to oftentimes traders. Sometimes they've got to understand 24/7 and how that's going to work for them. Many that are more traditional come with demands that are very common in the traditional world, but are not necessarily there in the digital asset space. So it can even be a question on how do I buy a stable coin? I've had that question. If they want to trade, and what's the difference between US dollar to BTC liquidity versus stablecoin versus BTC liquidity? So you see a large variety between the different players, but I think the big difference is we weren't getting those questions necessarily in 2024, and in 2025 we definitely were.
Yeah, that's interesting. I'd like to come back a bit more into the ETF point and then how we're evolved from that. But I know that 3IQ as an asset manager, when we were looking into the space, like one of the issues is for the sovereign wealth funds that they just didn't recognize any of the counterparties back then. And that obviously has changed quite a lot in the last 12 months, but it was just too many things for them have to go through the due diligence of before they could even get to that point. I actually want to reference the slide and talk a bit more about some of the hurdles that we're seeing, but Anthony had the slide up before that said the survey showed that most people in this room, so people in the digital asset space, thought that liquidity conditions in digital asset markets were unsuitable for institutional investors because there's insufficient depth and volume. Agree or disagree? And clarify your answer.
I think that it depends what you're talking about, right? So I would agree that DeFi is probably unsuitable for institutional investors. But I think that certainly in Bitcoin and the Bitcoin derivatives market in particular, there's ample liquidity. Now, it depends on who you're talking about. If you're talking about very large pension funds, very significant multi-billion-dollar allocations, then of course, yes, ultimately even Bitcoin gets stretched. Certainly the spot markets can't really absorb that. But in the derivative side, absolutely. I mean, there's great depths now in the derivative side on Bitcoin. As soon as you go down into altcoins, then liquidity tails off pretty rapidly outside the first 3 or 4. So after ETH, Solana, then But if you're looking at markets where there's if you're looking at coins where there's an established options market, then yes, there is enough depth for institutions to be involved. But again, that's not a huge proportion of the alts market, but still Bitcoin is dominant across the asset class. So I think that yes, it is a suitable. Bitcoin and Bitcoin derivatives are suitable for institutional investors.
You want to comment when it comes to tokenized securities, not necessarily things like Bitcoin or native tokens. I see a chicken and egg issue. And you have many asset managers tokenizing share classes or in some cases the whole fund. But when you go and talk to those organizations, you realize that the sales team would rather sell that fund in a traditional format, right? Because they see the demand there. And the guys who are doing tokenization, they don't have someone on the sales side who is actively pitching that product, but they are not incentivized. Now they are getting a bigger bonus in many cases, especially until this changed in the US, right? Because they were doing all these things as pilots, POCs. So you have innovation on the product side, but there's no one actively selling the product itself. This is finally started to change because, as you said, now even with Chainlink, as an IT vendor, we get approached by corporates who want to know, where can we buy a tokenized money market fund? Where we can buy a tokenized mutual fund? We are pointing them to asset managers. But in many cases, and I will not mention any names, right? Those asset managers don't have a sales force that is actively pitching the tokenized version of their own product. Right? So it's a chicken and egg issue, but they just in the US, I think, are going to make that chicken egg issue kind of disappear. But I think there has to be a change at certain asset managers and other product issuers where the sales force is incentivized to sell the tokenized version of the product. Which is not happening today.
That's interesting. It sounds like the product's there and the buyer's there, but there's just not the people in the middle or the communication to actually sell it. So, people have been saying for a while the institutions are coming, and I haven't, as someone who's been on both the sovereign wealth fund side and the asset manager side, that hasn't really been entirely true. I think there are still some roadblocks, and I know all of you are speaking to the large institutions quite frequently. What do you see as some of the roadblocks still? And then we can talk about the exciting innovations that are happening in the space. And maybe, Evie, we start with you, because I know you have a broad spectrum.
And the roadblocks, I think the practical sense, still many need to come up, but I think when we think about institutions, definitely traditional institutions, taking a step back, it takes a while for an institution to implement something. I already know what we're going to build in the next 2-3 years. So it's oftentimes decided up front and it's much less dynamic than in the startup space, right? So these things take a bit more time. Also, the robustness of what is being built is definitely taking into account when you start looking at large institutions coming in. But you have smaller institutions that can be more nimble, that can be more flexible and come in sooner. And people are looking for education, as I said earlier, so I think that's quite positive. And you have some players like ourselves who can actually offer you services to get started, and you don't need to do the whole learning journey for 5 years before you can get there, right? You can get institutional gate custody, you can trade on a regulated bank rate exchange, you can do the derivatives and options through us, and we will take care of the credit risk that comes with that, and you're facing DBS. So there are definitely partners that you can partner with across the world, a few, where you can solve that, and that's what we're doing very actively with a number of institutions. I also think on your previous questions, yes, there is in Bitcoin there is depth and volume, but it is 24/7 depending on the timing in the market. It is not as deep as you might want it to be at all times. And so with more institutions coming up, it will improve, but it will be a gradual push.
And Karl, what about your side? Because I know, and I have to commend you here because we're both based in Abu Dhabi, and you do so much in terms of the education in the space to bring people up to speed. So firstly, thank you. Secondly, how have you seen like the feedback from investors change from your side?
Yeah, I mean, I think things have changed, maybe not as fast as we would like, but I think it's happening, and we see it. You and I see it on the ground, and I think Paul and the team at Komainu. And again, all of the work we do is also thanks to the team on the educational front. But so again, I landed in Abu Dhabi. I've been there before. I've been there since 2011. I was working on the buy side with Mubadala. And I do remember when I first took on that role, I was like, that's it, the doors are open. And would look at everyone I knew in Mubadala, we like you, Karl, but it's not the right time. And then 2025 was very different, right? Again, regulatory certainty is here. I think it's no longer an issue. It's more to Evy's point, I mean, operational readiness, right? I mean, we see it internally, even in our company. Integrating AI, for example, now in everything we do in all of these processes. It has to go. I mean, you've got risk, you've got compliance, you've got cybersec. They all need to get involved. And the time to get anything implemented takes time already in a scaled up organization like ours. So operational readiness is still not there. And that's the reason why those institutions go through the route they understand. And if there was no BlackRock, they wouldn't have done it even till now. So, I mean, a compliance officer has to look at rechanging if they have clients like a bank, onboarding is very different. KYT, for crypto transactions is very different from what you do in fiat transactions. Then you've got the risk person that's going to look at it. I mean, looking at maybe volatility in the first 5 years of Bitcoin and not looking at what happened in the last 2 years. So really changing those frameworks, operational 24/7. TradFi doesn't operate 24/7 today. Right? You go in the office at 9, you leave at 5, and on the weekend you're off. So these are all roadblocks that hopefully we can help overcome by building those solutions. Custodians are there, now they're institutional grade, bankruptcy remote, they're backed by big balance sheets. I mean, we see Zodia as an example, and again, not naming, but Standard Chartered, Zodia Custody. The reason they're successful in the UAE now is because Standard Chartered is backing Zodia Custody. You've got a big balance sheet, so you're comfortable with dealing with that. The second is the knowledge gap, but to your point, this can be accelerated. So where we are today, and I think what's going to happen this year, is there's a lot of work that happened in the background that we don't necessarily see. A lot of POCs are out for a lot of these institutions, and they are getting more and more comfortable with using crypto rails versus staying just on TradFi rails, because it's great to buy an ETF, but it's not 24/7, and a lot of things happens over the weekend. So I'm very confident about 2026 from the conversation we're having, and I'm sure you're having too on the ground. I think we will see by the end of this year more institutions holding Bitcoin directly, not necessarily going to the ETF. Now, to Paul's point, I think there is liquidity enough on BTC, but again, when you talk 1% allocation of one of those sovereigns, that's a few $1 billion already, yes. Right? So they come to you, they're like, I want to buy $1 billion. There's not many players out there that can execute properly. So you have to go to different players to do that trade. And then you can use the derivatives market. Coinbase acquiring Deribit is great for the market because Coinbase is a publicly listed company. So these organizations might be more comfortable trading on a centralized exchange like Deribit now that's owned by Coinbase. So I'm very positive about this year, and I think we're going to move beyond, and we'll talk about that later, passive allocation versus active allocation in this space.
Maybe one comment. You mentioned custodians. In the early days, people thought that crypto was going to disintermediate some of the traditional players in finance, but I would argue that custodians like Komainu or Signum will actually be key enablers because they take on a very significant part of the operational risk.
Yeah, and I was going to chip in as well. I think the education point apart, and I completely take that because many different institutions are at different levels of their journey and how educated they've become. But the key challenges in this market, firstly, are massively fragmented liquidity. So you've got multiple exchanges. So any TradFi organization looking in sees a plethora of different counterparties. First question, how do I deal with that? Next question is, even if I do get my head around that, how do I deal with my collateral requirements? So if I'm trading on these venues, how do I make sure I have the right collateral in the right place at the right time, right? Because again, it's 24/7. None of these TradFi players are set up for 24/7 collateral movement. Most of them are on T+2. So, that is a very real change in mindset, change in operational procedures. Because, so what they look for, and I think, I agree. I think DBS is ideally positioned for this. Huge balance sheet player, great credit. So that's another important factor. But also being able to offer a range of solutions in a one-stop shop is what these institutions want. They don't want to have to go to set up multiple accounts on multiple exchanges and deal with all that hassle. So again, we as a custodian, but offering services on top of that, that's exactly what we see ourselves as. We see ourselves as providing a gateway to these organizations to be able to get their head round trading on multiple venues while still keeping their assets in custody. And that's our USP. You keep your assets with us, we look after them in secure custody, and we mirror those assets on exchanges. So you don't have to pre-fund any of your transactions there and take the credit risk of multiple counterparties. And we think that's a game changer in the market.
It's a really great point about the operational risk, because I feel like what used to be keeping investors on the sideline was like that reputational risk. They didn't want to be in the headlines. Now I feel it's more moved to the sort of the operational or the headache risk or the risk that comes with it, because people think of like digital assets as an asset class, but in reality, like it's an entire market. Like any piece of alternative allocation that you can think about, like private credit, private equity, commodities, like all of that could be digital assets. So I think people almost get overwhelmed with that. So we need to make it as easy as possible for them to actually enter the space. And it's not easy to your point, Evie. Like it's very fragmented. I do want to talk about in the last 15 minutes, just look at for investors that have made the move, and many via the ETF, for example. Now that they're in the space, they're comfortable with doing more. What are some of the innovations that we're seeing in that space, whether that's yield, whether that's active management, hedge fund strategies, collateral management? Would love to hear about some of the innovations now or what we're looking to see in the future. And I'll start with you, Fernando.
Yeah, absolutely. Let me focus on tokenized securities. For many years, we've been focusing on operational efficiencies. You have a shared ledger, a single, a golden record. You don't need to reconcile. You can have cash and the security itself on chain, allows for programmability, you name it. But in many cases, that is not enough to justify the investment of coming up with new operating procedures. Why take the leap of faith if there's only downside? And I think the focus now is shifting towards utility, value. Why would someone hold an asset in a tokenized form factor? If they can use that tokenized, let's say, fund and send that over to a DeFi pool where they can borrow stable coins against it, or they can get additional yield, or if they can take this tokenized fund and send it to a prime broker so that they can then trade commodities as CME. Now, all of a sudden, you can do more with that asset. It's not just buying it, holding it, and eventually selling it. You don't need to sell anymore. You can get more out of it. Collateral utility is one of them, but I think Web3 has shown that once you become an asset holder, you should be entitled to get yield out of it. That has a value. Why wouldn't you be allowed to use that as collateral to other transactions, right? I think that's going to be the key unlock and one of the biggest sources of innovation. And that's, we as Chainlink, we are focusing on that.
So let's go more into extracting yield from, and whether that's tokenization or through other means. Maybe Karl, you want to talk about what you're seeing in that?
Yeah, I mean, from our standpoint, I see more that not really innovation, but more a natural evolution of, and again, a repeat of what you've seen in TradFi, maybe in the early days of hedge funds in the 80s. Investors got allocated in a beta exposure, either ETF or even Bitcoin directly, which we are seeing even at the institutional level if we talk about sovereigns. The next step is once you hold that in your treasury, a treasurer will say, okay, I mean, I'm holding that asset. How can I generate yield? Can I generate yield out of it, right? If I hold dollars and I place them in a deposit to the bank, I'll get a certain percentage. And that's the conversation we're starting to see, maybe less yet at the big institutional sovereign level, but more at the B2B2C. So banks, private banks. Last year, we announced a partnership with a Swiss bank that offers custody of Bitcoin and have been doing so since 2019, that offers lending on Bitcoin. And their clients were like, well, next for us is we want to generate yield, right? You charge us for custody, you charge us for lending. How can I generate yield? And the fact that, Swiss regulated traditional bank gets more and more comfortable, and that's because the demand is coming from the client. I think a lot of that is going to happen this year. So Bitcoin yield is a big topic across every single player. May they be digital asset treasuries, may they be Bitcoin miners, may they be sovereigns that hold Bitcoin on their balance sheet. They want to start extracting yield because, again, to my colleague's point earlier today in one of the conversations we had, are we going to see 1,000x in Bitcoin? Volatility is coming down. You want to be able to extract more yield of what you have. Bitcoin miners are focusing more on the AI side of things and data centers and all of that. So you need to be able to generate. And I think today we are ready for that, not just us. There's many other players out there that offer different ways to generate yield on Bitcoin. May it be like we do, at least on our side, on the option side, right? Volatility selling, that's something we do and we're very comfortable with. And treasurers like this product, but it's not a product that we offer to a hedge fund manager that is fine with more volatility and more return. So I think we're going to see more of that, and that's driven mostly by client demand. And to someone's point earlier on the panel that was saying, we hope crypto will not be left out because, again, what we see is people are comfortable with what they know. And you've got the JP Morgan that offers custody, that will offer lending and eventually yield. Will they do it on their own or will they do it with specialized and crypto players like ourselves and others in the market?
And so, Evy, with you as the one-stop shop.
I'm sorry to tell you, we did it on our own. So yes, Bitcoin yield has actually been a question. Actually, generally, yield has been a question for many years now from clients. We have to think about doing that safely, meaning to say we had all the borrow-lend craze and people lost money doing that, right? So counterparty risk became much more of a topic since 2022 and that whole period. So yes, we offer the structured products, we offer derivatives on an OTC basis to the private bank and to institutional investors. More demand from the private bank, as he said, and distributing to other private banks. The choice we made was that we don't only offer it on Bitcoin itself, we also offer it cash delivered as well as on the ETFs to be able to give the optionality to the clients and being very cognizant of the fact that not everybody can deal with physical delivered yet. For example, that's beauty of this year. The American banks, the American players have the restrictions have been reduced, so they can now start looking at holding physical Bitcoin, whereas in the past we would need to deal with them on a cash basis. So those things are, I think, very positive evolutions and a very natural evolution from what you would expect. It's a natural evolution.
Is there a risk that with a lot of the traditional, with the banks coming into the space and doing all of this themselves, that we will see less innovation coming out of the crypto native companies? Like, do you think this is going to be crowding out, or the banks will still look to that as their innovation? Like, that will be the funnel that like sovereign wealth funds go through to reach that innovation?
I think I would add, I think, I think there's going to be a move over the next 12 months more towards, let's call it the large balance sheet providers. Some of those may in fact be crypto firms, but I think the banks are very well positioned. They tend to be more slow moving and methodical, so maybe innovation will be somewhat curtailed, but I don't think the banks are going to be massively focusing on DeFi. Again, I think they're going to be focusing on the large part of the asset class, which is around Bitcoin and the top 10 coins. So that would be my view.
So maybe adding to that, what we see is that the innovation will still be driven by startups and some of the crypto natives, but it's going to be especially with big balance sheets that we want to bring us the scale. You mentioned depth of the market, and in the DeFi it is tiny, and in many cases to offer certain services you need the balance sheet of a bank. So I think in a way, traditional institutions and the more crypto native players, they complement each other. I don't think they are antagonists in any way, right? So I think we'll see a convergence. Actually, we are already seeing that.
Yeah, I would say the same. I mean, we look a lot at what is happening in the DeFi space, for example, because that's the far end, and then we think, okay, what of that thinking, that technology can we bring back as and when we build? But it's going to take us a while before we could even think of doing that. I would also want to say you're right. I think it's very positive that big players are coming in because, for example, when you think about lending and you want to hedge your risk, I need a counterparty that can take the volume that I want to cover. And honestly, there aren't that many that can take from a balance sheet point of view, from a credit risk point of view, that can work with. Also, I got to think about wrong way risk, right? So I've got to be able to work with somebody that's diversified. So that I think is also very positive when more players come in that are diversified. So I have much less wrong way risk than when I work with a very specialized firm. So I think all in all, it's positive, but I don't think we're necessary. I think both can definitely exist and should exist together.
I actually would, and I know that you have something to add to that as well, so we will come back to that, I promise, because I think the scale piece is really important. But question from the audience, what can we expect the Clarity Act to improve for institutions? How important is that for inflows?
I would say more clarity is always good.
Clarity Act, one word.
Just more clarity is always good.
I mean, from your perspective, and I wanted to just quickly go back on, there were a lot of talks about stable coins and payments being the big thing for this year, and I think they are. And I think this is what's going to lead to maybe in the next couple of years where you won't talk anymore about TradFi and crypto, right? Because all financial institutions will then be working not on two stacks anymore, but on one stack, tech. And I think Jenny Johnson was spending a lot of time talking about their IT department. So this convergence is happening because of, I wouldn't say the most boring instrument, but stable coins, which is just a digital representation of the dollar. I think that needs to happen first because the demand is there and because it adds a lot of value for all the players in the ecosystem, where we're going to get to a point where we won't call anymore crypto. I mean, it will be finance as we know it, finance 2.0 or whatever it will be. So I think we're at a very interesting segue when this happens. And on top of that, again, the Clarity Act and other regulations that are going to come up, which are necessary. If you get yield on stable coins, what is it? Is it a security or not? Once you get that clarity, I think, it will be a convergence of these two ecosystems. And hopefully we'll also see a consolidation. So a lot of those crypto players that have been in the space that have innovated and will continue innovated is like fintech and banks. Fintech will always exist despite banks being around. They innovate and then they get acquired by those bigger players and then consolidation.
Maybe just one comment, maybe a bit anecdotal, but we at Chainlink, we provide technology and services like Proof of Reserve to many stablecoin issuers. And the big potential users on the corporate side, they would tell me, we want to use it, but we are waiting for the Clarity Act. So it's not that we've done a full market analysis, but I get a a handful of clients that I can think of that are really waiting for that. So I think we'll see significant inflows.
And I also think it's, it's not a bad thing with the delay. Like, it shows that, they are giving it the sufficient amount of importance and they want to get it right. I think they see the knock-on effect. And going back to the point on scale, it's interesting when people are like, oh, there's not many institutional investors coming into the space, but there hasn't been the scale available for them to enter the space. Like on the hedge fund side with the Addias, the Mubadalas, for example, if they want to invest 100 million, not own more than 20% of a fund, there are very, very few options. There are some excellent big players out there, but the market has been limited in terms of finding ones of scale. So
but in 30 seconds on that point, what's happening, and we're seeing it, is all the traditional hedge funds they deal with today are now entering the space and adding crypto sleeves and adding crypto managers to their offering. Because when you think about it, if you're on the sovereign or you're a risk person, you don't have to go and do due diligence on a new fund, right? You say, well, I know this big hedge funds out there, we work with them, you do the due diligence on those crypto, you add that sleeve, and then we can absorb. Because the problem we have today is capacity constraints, right? Can we trade, can we generate alpha on the $1 billion allocation? So yeah, we're seeing a lot of that now, and that comes from traditional hedge funds that are getting into crypto.
yeah, absolutely. I know, Paul, you looked like you were chomping at the bit.
No. It was earlier on. Actually, it was more on the yield point. I was just saying that I think Evy made a very good point, which is that I think credit risk and counterparty risk are very poorly understood in this ecosystem, and particularly credit risk. So often the yields may seem attractive, but actually look to see who your counterparty is, who you're really dealing with, and even if you're earning a 10-15% return, does that actually reflect the risk you're really taking if you measured that in TradFi terms? Most often not, obviously, otherwise you wouldn't be being paid that yield. So I think my message would be make sure you're not the yield when you're actually dealing in these instruments.
Okay, we have 1 minute left, so quick fire, 15 seconds each. What is one thing you would like to see in 2026 in the institutions coming into digital asset space? I'm starting with you.
More players like us coming in heavy.
Karl.
Moving away from beta and doing more on the alpha side of things. So we would love to see one of those big players doing yield as their next vantage point or entry point.
Fernando?
So it would be for investors to take full advantage of the utility and value that tokenization can bring. Let's go beyond just getting operational efficiencies, whatever that means.
Yeah, for me, it's wider participation of the big balance sheet players coming in and really pushing this market forward and making properly sized allocations from client assets. And DBS is leading the way on that at the moment, as far as I'm concerned, and doing a fantastic job.
Literally 2 seconds left. You guys are the best. Thank you so much. Warm round of applause for my panel, please.